All right, this is part 5 of lecture 1 of State and Local Public Finance. And as I was saying, redistribution is the function of government that tries to make sure that income or wealth is redistributed in a way such that we reduce the inequities that are in our society. And the part of state and local government that deals with this is essentially our income tax system, where we have a more or less progressive tax system in most states, at least, that takes a higher percentage of income from those in higher income brackets and uses that money towards providing social services and public welfare programs to ensure that everyone can be on more of a level playing field than not. This is also, as I said, was a function also at the federal level, where the personal income tax system at the federal level is even more progressive most of the time than most state income tax systems. Then we have allocation of resources. The third function of government is a function that really has more to do with efficiency, making sure that our resources are used to their fullest extent. And this really is the type of function that tries to take care of any inefficiencies or places where the market does not or is unable to function properly for various different reasons. One of these examples might have to do with externalities or negative externalities more specifically. So, for example, if we have lots of manufacturing plants that are emitting acid rain producing materials in their smokestacks, that is going to be an inefficient allocation of resources, because these companies or manufacturing plants that might be emitting this type of pollution are creating negative consequences or negative externalities for everyone else that are going to be hurt by the acid rain. Yet, the manufacturing plants themselves do not have to take into account that cost. And what that leads to is an overproduction of both that kind of good and also the acid rain producing chemicals in their smokestacks. So where the government might step in and intervene in that particular scenario is to either regulate these industries that emit acid rain producing chemicals, or alternatively, in a more state and local public finance perspective, the government might be able to step in and say, we are going to tax you if you are emitting polluting materials. And in this case, if the firms that are producing acid rain chemicals are taxed, this means that they are now able to take into account the cost of emitting this particular kind of pollution, and are then able to produce at a level that is more consistent or efficient according to all of the different costs and benefits associated with their projection. So that's just a really broad example, but what I'm trying to say is that state and local public finance is going to more or less touch on both the redistribution and the allocation of resources components as main functions of the government. And this is a good framework to keep in mind when you're thinking about, this particular kind of policy, which function of the government is that going to pertain to? All right, so this slide basically is an overall overview of the course. We're going to be looking at some determinants of local spending, thinking about some of the economic development implications of different tax exemptions and different policies to attract businesses. We're going to look at very carefully the sources of state and local revenues, particularly property taxes and sales tax and income taxes. we're also going to be thinking about evaluating certain types of tax policies. And what we mean by that is to be thinking about the efficiency of taxation. And efficiency in this particular context refers to economic efficiency. So it's not so much the normal kind of efficiency that we're talking about, whether someone is doing something efficiently. We're more talking about economic efficiency. Are we taking into account all of the social benefits and all of the social costs associated with a particular kind of taxation? We're also going to be looking a little bit at equity in that particular context. So tax policies, even though they don't sound like a super exciting area of study, but in fact, understanding what the efficiency and equity implications are gives you a very good platform on which to either support or not support a certain type of taxation. And then, all right, so I wanted to introduce you guys to a couple of vocabulary or lingo in this kind of context, and you might have seen this before already. And one of these is whether we're talking about a positive or normative type of analysis. And we're going to be covering both types, both positive and normative analysis. But I want you guys to keep in mind the very important differences between these two types of analyses and when you're making a statement, whether you're making a more positive statement or a normative statement. All right, so the first type, positive analyses, is examining the behavior of voters, businesses, and government officials. So basically, what we're looking at in this type of analysis, positive analysis, is basically if we, for example, charge, if we institute a sales tax in the state of Oregon, what will happen to consumer behavior? Will people buy more or less of certain things? How much revenue are we able to generate from a sales tax? What populations will it affect more of? Will it affect the lower income population more or the higher income population more? What are the types of goods and services that are more affected by consumer behavior, for example? These are positive analyses. And in principle, these positive analyses and positive statements can be tested against evidence. There's usually going to be a right or wrong answer in terms of a positive analysis. It doesn't have to be right to be a positive analysis. So for example, the Legislative Revenue Office did a very large analysis of what they think will happen to marijuana tax revenues once we started the legalizing recreational marijuana. And they had to make some assumptions about people who might be switching from medical marijuana over to recreational marijuana. They had to make some assumptions about people who didn't use marijuana at all before, who are now going to take advantage of the new recreational marijuana. They also had to make some estimates about visitors who might participate in this particular market and come up with a final calculation. Now, if any of these assumptions or estimates are wrong, their final estimate of what the total revenue can be might be wrong, but it is still a positive analysis, meaning that they are purely looking at the cause and the effect. If we legalize recreational marijuana and collect a certain amount of taxes on them, what are the revenue implications? Okay, so on the other hand, normative analysis is much more fluid in the sense that it examines the best choices for public officials to make. Or essentially, we're looking at, for normative analysis, what is it that we should do? So this means that, for example, when we're looking at normative analysis, one example of that might be, should we set aside 50% of urban renewal area revenues towards affordable housing, or should we set aside 70%? That kind of analysis or that kind of statement essentially has no right answer. It is basically a judgment call and thus falls into the realm of normative analysis. Essentially, it is a type of analysis that combines positive analysis with value. So in my example of whether we should be setting aside 50% or 70% of revenues for affordable housing, we can do positive analysis that says if we set aside 50% of the revenue, how much money would that be? And how many people can we provide housing to if we had 50% versus 70%? But whether or not which one would be the better choice or the right choice, that's going to be a judgment call that combines analysis with values. Great. Now that we've sorted out what is a positive or a normative analysis or statement, I just want you guys to keep in mind that when you're making a statement or you're expressing your opinion about something, whether you're thinking about it in a more positive way or a normative way. All right, moving on to our final slide for this lecture. I wanted to talk a little bit more about efficiency. So again, this is economic efficiency. So if you're reading the textbook in chapters 1 and 2, it touches upon efficiency in a lot more detail, but one of the most interesting most important terms that you'll learn in here is Pareto efficiency, or sometimes called Pareto optimality. So this is the condition or situation where we've reached the most efficient level. And this is the scenario where no one can be made better off without another be made worse off. Okay, so you cannot make anyone better off without making someone else worse off. And this is the best point you can reach in terms of efficiency, and that's the definition of economic efficiency. And next time when we do meet in person, I'll draw some graphs on the board and give you guys a little bit more insight into this particular efficiency condition. But before we do that, I want to introduce it to you today, and so you'll have a little bit of background when you're reading the textbook. So the condition at which we reach this Pareto efficiency is where MSB is equal to MSC. So what these words stand for are marginal social benefit is equal to marginal social cost. And this is the point, if we do it graphically, this is the point, where we're at a level of production or provision of goods and services where it leads to the greatest net gain or total surplus for the entire economy. And what this means is that this is going to be the most efficient allocation of resources such that we create a pie or benefit that is as good as possible for society. And this is the point where we want to be at. Now, being at a Pareto efficient point is great in that it creates the biggest bang for your buck, basically, biggest piece of pie for the entire economy. But that means that this is definitively efficient, meaning that no normative judgments are necessary. And if we're inefficient, no one will be opposed to getting to a more efficient point. But on the other hand, it is a narrow definition and doesn't resolve all of your social issues, because you can be most efficient, but it doesn't say anything about equity. It just says as a whole the pie is as big as possible, but in terms of how that pie is distributed, it is not concerned with that. And that is why Pareto efficiency is good, but not perfect.